Hi, Dominique. Welcome to another edition of the Week Ahead. How are you doing?
Fine, thank you, Andrew. How are you? You have a beautiful
I'm just enjoying some time on the beach. I'm not in London and it's 0 degrees and damp outside. So still almost, I don't, maybe a little bit more quiet this week. I guess it was relatively negative for risk, but let's kind of dive in as we always like to do and kind of recap I guess data that came out, market reaction, any Fed comments, and kind of what you agree to didn't agree, I guess, in market reactions.
So the Fed was out because they have their meeting on Wednesday. In terms of data, things rather went my way. The Atlanta Fed GDP now is up back in a 3.4% handle. The very important Atlanta Fed median wage came out yesterday, and it's not looking great for the Fed. It's still stuck around 6%. The wage for job switchers who are really in the market continues to accelerate, 8%.
So what does that mean? That means if they switch jobs, they're getting 8% higher.
Yeah. Okay. Well, it means the wage of people who are who have just switched jobs, those wages are growing at a pace of 8% on a yearly basis. So we're not talking about no inflation, nothing to see here. Actually, it's big and it's not getting smaller.
And then are you surprised that the bond market hasn't been selling off more? I'm just looking, I guess the long end, it kind of has a bit today, but in general, are you surprised by some of the moves or not really?
Well, yes. The market does not believe Mr. Powell when he says that, he's going to get tough on inflation if he has to. And so next week is Powell's opportunity to restore his credibility that has been battered by the talk of a slower rate hike. So let's see how that turns out.
Right. But why should his credibility get questioned? Because most central banks, maybe not the ECB, although they're starting for so low, but and maybe New Zealand, but a lot of central banks are talking about, no one's talking about cuts, but are talking about slowing the pace and seeing what the impact is.
Well, I mean, the linkers market, and Bilal has written a couple of very interesting notes about this, which I hope our listeners will read. The linkers market suggests the market thinks the Fed is going to raise its inflation target to 3%. Now, the Fed is never going to announce the target is 3% when inflation is running at 6-7%. But if this is what the market thinks, then it thinks the Fed is not going to be very energetic when it hikes next year. And I guess that's what the lack of market reaction to the news that were positive for inflation. That's what it.
I mean, listen, I guess risk equity sold off earlier in the week, and I guess have been treading water relatively since. So, okay. Anything else about the price movements, curve movements in the last week?
No. Let's talk about the Fed, my favorite topic.
Okay, fine. So the big time, obviously, we've been talking about this. There's a big week. Okay, I guess the last real week for a lot of people in markets. So let's go through data, big announcements, Fed. Yeah, all your thoughts.
Okay, so the Fed, 50 basis points. We didn't get Nick Timiraos to tell us plans have changed, so we can assume it's 50 basis points. The more interesting thing is what happens to the SCP, because I think it has strong implication on the Fed reaction functions. So the first thing the Fed is going to have to do is to mark to market their prediction for end 2022 inflation. Core PCE is currently 5%. In my view, more likely to go up than down in December. In any event, the SCP shows it at 4.5%.
So this at the end of next year, no.
Of this year. So they have to, I thought it would be 4.5 and it's 5. And so they have to raise, this is what I call mark to market. Now, what do they do with all the rest of the inflation forecast? I'm assuming that they are not changing it. If they raised it, it would be a sign that they are soft on inflation. So let's assume it doesn't change. Then what do they do to the terminal rates? I mean, do they raise it to the terminal rate and to the Fed funds over the projection period? So do they raise the terminal rates? I'm personally thinking 5.4, and let me explain why. I mean, the market is a tad below 5. It's because before the blackout, the hawks, the doves led by Daly, had been talking about 5% as a good place for the 2023 dot. But this was before we got the NFP. And before the Atlanta Fed median wage. So I'm thinking that initially they were probably in a 5 to 5.25 range, and they're probably going to go to 5.25 to 5.5. So that's how I get my my 2023 dots. But
okay, and let's say 5.25, 5.5. We could get there by the first 2 meetings in next year being 50 each. Is that what you're thinking, or?
Yeah.
Or you think they'll slow and to 25 and then?
I'm expecting inflation to remain in a 50 basis point core month on month, around 50 basis point. And so, no, I think they will just have to keep going. No, this is the most interesting period for me, because we are going to find out, based on the inflation print of the next 2 to 3 months, whether my 8% call is going to happen or not. Right. So, no, this is going to be really interesting.
So I just want to clarify. So they have a prediction for CPI or PCE? Which?
So they have 2 predictions for PCE, headline and core. Core is a more interesting
PCE,
one.
okay, so and PCE is lower than CPI.
So PCE is typically lower than CPI. Yes.
Okay, fine. That's what, yeah. And so they're focusing on PCE. Obviously, the market focuses on other factors that, you know, to get a better understanding of inflation or prediction of where PCE may become. But so do they have a prediction for where PCE ends next year?
Yes, they do. And I believe they sit at 2.6%, which I think is widely optimistic.
Okay.
Yeah.
I'm just curious, like, how quickly did they think inflation should come down? Like, is it 0.2 every month, or is it on an annual basis, or is it like bigger drop than that? Well, like, is it going according to, like, obviously it's still high. I mean, we're saying CPI on well, year on year will be 7.3, and ex food and energy 6.1, and obviously we're saying CPI is a bit higher, but I'm just curious, like, how fast are they predicting for it to fall?
Okay, sorry. So they are expecting 3.1% inflation at the end of next year, and then 2.3% at the end of 2024. But even 3.1, I think, is widely optimistic. To get there, we need to start to see a marked slowdown, and that is not at all what we are seeing.
Right.
So, it's a little bit when you tell me by how many basis points do they need to see it fall every month to meet their target. It's a little bit like if you were an oncologist and you looked at a tumor and said, oh, the tumor is only 2 centimeters wide. All I need to do is to have it fall by 10 millimeters a month, and in a few months it will be resolved. Yeah. That's not how the world works. I mean, the economy.
That's what I'm trying to understand. Exactly.
Yeah.
Exactly. Okay, cool. So the thing you're looking for is the.
So I want to see what they do to their trajectory. Like, for instance, I'd like them to see to the Fed funds trajectory. I'd like them to raise the median Fed funds rate in 2024 by as much as the median Fed funds rate in 2023. Ideally, I would like them to not show cut in 2024. And let's see, this is their chance. Because the thing is, since I've been talking about going 50 basis point a meeting, financial conditions have eased. Financial conditions.
I know Bilal was talking about like 5-year was coming down a lot. Like the market's pricing, I mean, that's further out, but the market is pricing these cuts, and now they're like emboldened by this kind of.
Totally. So the SCP is the FOMC opportunity to build credibility. If they show, a 75 basis point increase in the 23 dot, but less of an increase in the 2024 dot, I will take it as a sign that even though inflation is the lowest in 40 years, and they have fully met their employment mandate, they are not serious about inflation. And then if that is the case, then we are going to have serious bond market volatility next year. Yeah.
Okay, cool. And then on the key data coming out, obviously it looks like we have a lot. What are you viewing as the most important, and does your views kind of deviate from the market views?
Okay, so the CPI obviously is the most important, and there we have a clear framework that Chair Powell gave us. He broke the CPI between core goods, housing costs, and core services without housing costs. So I am expecting a total increase around 50 basis points. But I'm also expecting to see stabilization of goods prices. I think the market is far too optimistic with its expectations of slower housing costs. For sure, house prices are falling, but it always takes time for house prices to transmit to rents, especially when the economy is strong as it is now. So I'm actually expecting housing costs to continue to increase at a 8 to 9% annual clip. And I'm expecting non-housing core services, based on the acceleration of wages we are seeing, to increase further. So we have that. It's coming out a day on the first day that the FOMC meets, so this will give them things to talk about. Then the other two important data. So we have retail sales, where I think again the consensus is a little too optimistic. And by the way, I've been too pessimistic. I've been saying this for like the past 3 retail sales. Each time we've had positive surprises. And then there is a piece of data that I usually don't.
So the market's actually predicting for retail sales to fall slightly month on month.
Because they are looking at higher frequency indicators like credit card billings or what have you. And I'm looking at it from a macro perspective. I'm trying to find a consistency with my broad view. And then there is a piece of data that I usually don't pay much attention to, but I think this time around, it's really worth monitoring. And that's a deficit, the government deficit for November. And the reason I'm paying attention to it is that the key driver of my optimism on growth is that fiscal consolidation is over. And I think an increase in the deficit relative to last year is what the consensus expects. I agree. And this shows that, fiscal consolidation is behind us. And again, I find this view a bit inconsistent with...
you've been right, yeah.
So we'll see, but big week, and hopefully the last busy week of the year.
Yeah.
So we can all go home and digest this unbelievable year.
Sorry, last question I had is, if U.S. manufacturing and U.S. services PMIs are both under 50, shouldn't that mean the economy is slowing?
So two things. First of all, the services PMI, the one that I look at, which is from the ISM, because the other one...
That's high, yeah.
That's high. It was higher than expected.
That's like 55 or something like that. Or
57. And there's been a decoupling of the PMIs from GDP growth. It was happening before the pandemic, and it's even stronger now. So what I'm really focused is employment and spending. I'm really focused on.
Awesome. Anything else we should think about?
Lots, but for now, I think that's suffice.
Last question, the Senator Sinema, which I feel like you predicted this a year ago, but I think, so you don't think this weakens the Democrats and maybe makes the government be more fiscally responsible because, or she's going to vote however she wants to vote anyway. So it'd be like her and Manchin.
Well, she was already keeping a government fiscal policy, I wouldn't say hostage, but certainly exercising a lot more influence than a single senator usually would. And that's not going to change. So I don't think in other words, she's not going to suddenly vote more conservative because she has left the Democrats and is now listing herself as an independent.
Fine. Okay, awesome. So as we've been doing last few weeks, a quick recap for some of the interesting things we sent out this past week for our Prime users. Bilal did a very interesting report using his ChatGPT, how this could potentially change your life. I know you...
Fascinating.
Really seems, and I think we're really using it. Which has been super cool, but a continuing also a long kind of history of, since Macro has been around, we're always trying to use kind of the most kind of, I guess, current or innovative tools in providing insights and how we deliver things to our clients. So that's kind of continuing that trend. For Prime trades, some of our favorite trades that had a position for 2023. That is definitely worth reading. For professional users, one I think it's either sent out today or be sent out on Monday, which is a recap of our machine learning webinar from yesterday. Clients should all definitely check that out. Gives an update, a lot of the cool stuff that Bilal and Dalvir have been working on and how we think this can improve trading returns, particularly around FX carry. We released the China growth tracker, which is always interesting, looking at hard and soft data there and how that's been changing since China is moving away from the zero COVID policy. And the last thing, which I think you started talking about, Dominique, which was for the rates weekly, which I was kind of reading some of it this morning, Bilal talking about why we kind of closed our curve inversion trade for the US, and lo and behold, it's actually I think went from like minus 2s, 10s, has flattened a lot or uninverted right on that time. And that, I guess, really comes down to the Fed credibility.
It's not this. I mean, this story is going to play over many months. And also remember what happened in the 70s. Initially, the Fed was not prepared to tackle high inflation, and inflation got even higher. So it's not over.
Yes, it's not over. Exactly. So, okay, we wish everyone kind of, good luck. Obviously, happy holidays. Dominique, you want to give any last words?
No, I'm just hoping that this is it. I've been, calling for a quiet week. This is our last busy week, and we can all go and digest this incredible year we've just had.
Exactly. Okay, cool. Good luck, everyone.
Good luck.